Hi everybody, this is Dan at Theta Trend. Today is Sunday, October 20th. It's about 7:18 a.m. here, Mountain Time. Uh, and I wanted to put together a video to sort of go through two things. One is that I'd like to discuss the indicators that I'm using here and how I use those to trade uh, credit spreads. And the other is I want to talk a little bit about we have situations like this where right now what we're looking at is a chart of the Russell 2000, the IWM. And, clearly this is year to date, basically. This is the start of 2012 here, or the end of 2012, rather, sorry. Um, Clearly the Russell's been in a pretty pronounced uptrend the entire year, as all stocks have been, and that shouldn't be news to anybody. But we have these situations here where, like on Friday, we got this gap higher, and, everything's been sort of on a run here. And suppose you didn't have a position open. I guess one of the things I'd like to discuss is, whether or not you should open a position after the market gets so extended like this. And there's a way of looking at things in a systematic manner so that we can say, yes, this is a good place to enter. No, this is not a good place to enter. So to begin with, what I'd like to do here is just talk about what we see. I have some moving averages, and then I have an average true range trailing stop. So the moving averages I have here, this is the 200-day, the red is the 50-day, the yellow is the 10-day, and the 20-day is the green. I just use a simple moving average, and in all honesty, I really don't use them for the credit spread trading. It's just something that I've been used to seeing, and I kind of look at it and just say, here we have two moving averages that are sort of moving sideways. It doesn't mean the price is going to start moving down necessarily, but it means that it's less likely that it's going to advance really, really soon. Whereas here, you see a sharp snap in the moving average, and the slope of it, I guess, becomes upward, and that suggests to me that the price is going to resume some sort of an upward path. And that's about all I really use them to think about. Maybe it's sort of an early warning sign that things might be changing, but aside from that, I don't use them specifically to trade the system. Down below here, this is an indicator that I put together, and what it is the green line is the implied volatility of the options, and the pink or the purple line, whatever that is the historical volatility. And I think that's over the past 60 days. Let's just say it's over the past 60 days. And what I'm looking at here is we always like to see implied volatility greater than historical volatility, because it implies that the price of the option is a little bit mispriced maybe. It's saying that, for taking the risk, if you were buying it, you're going to have to pay more than we've seen in the past 60 days or whatever this happens to be. Down here, this is a standard deviation scale. And what this does is, I'm not sure why that's not coming up. Maybe if I move this one up a little bit. What this does is it looks back over the previous 20 days and it plots the standard deviation as a spike of the individual trading day. So what does that mean? I guess, like this day, let's see, come up here, this day, which was October 10th, was a little bit over a 2 standard deviation up day based on, the amount of movement we had seen over the previous 20 days. Down here, this is just a standard rate of change, and this is over a period of 60 days. And I really don't use this. It's just sort of a momentum indicator, but I trade a monthly rotation system, and so for that's entirely based on momentum, and I like to have this here just to give me an idea of what the momentum of a few things might be. So the software we're looking at is Thinkorswim. So if you have Thinkorswim, specifically on a Mac, this ought to be really easy. So in studies, I go to edit studies, and here, you can see my simple moving averages, 2 lines. One is 5,200, one is 10 and 20. Nothing super exciting. This is the average true range trailing stop that I use. And so I used an unmodified trailing period, and an average true range period of 5. So basically it's looking back over 5 days to say what's the average true range. And then the factor I use is 3.5. So it takes the average true range over the previous 5 days, whatever that might be, and it offsets a trailing stop, 3.5 average true range, either below or above it, depending on, the direction of the trend. And this modified, unmodified thing is sort of confusing. What it is, as far as I can tell from reading the ThinkScript discussion, is that the unmodified just uses the raw 5-day average true range. The modified, I guess, incorporates some sort of smoothing or something like that. I'm not totally clear. I've just, always used the unmodified. I don't think it really matters, probably. It's more of just, consistency with it. And this is not like a secret indicator or anything, the average true range trailing stop. It's just a point where we can manage risk from and sort of draw a line in the sand. Say we were selling verticals in here in a discretionary manner, it's sort of like, say price is here, do you want to be long or do you want to be short? Well, it's sort of hard to know. And then it's, if you want to say, okay, do I want to be long or short from where? At what point am I wrong? That's what this average true range trailing stop does, is it says, this is where you're wrong. It doesn't give you any sort of predictive power. It just gives you a point. And from that point, you can manage risk in a defined manner. And that's really, that's what's key here. It's not predicting price or anything like that. It's just knowing where you're going to stage battle from. So if we zoom in here a little bit, what we can see is this month we should have been short. What month are we back into? August. We should have been short in here. And then we got this close above our average true range trailing stop. And that just says to us, okay, well, we're not going to be short here anymore. This is an indication that the trend has ended, or it's at least shifted directions for the time being. And if we had continued to be short in here, especially after Friday, we'd be experiencing some pain. So this is the point at which we would have gotten out of the short positions and we would have been looking to enter long positions. And so now what I'd like to look at, I guess, is, and this month was really an easy month. I think I was involved in the IWM here either on September 30th or October 1st. I had a put credit spread that was opened up and it took a little bit of heat, but this is the same thing. Price never closed below this average true range trailing stop. It was a shakeout, so you stay involved. And that put credit spread was closed out on Friday when we got this huge gap run up here to a new Russell all-time high. But now I'm sort of looking at this and I don't have a position in the Russell anymore. And I'm saying, okay, well, this is my new stop level. Right, 105.78, 105.80, I guess, is, you can see here it's saying 105.80. So, and this little arrow thing over here is just an alert. So if price hits that level, that's a warning to me that I need to be watching a position that might be open if I have one. But at any rate, this is our line in the sand. This is where we say, okay, we're wrong on being long if price goes below 105.80. And until that happens, we want to be long this market. So now what I'm looking at is I'm saying, okay, I don't have a position open here. What should I do? How can I analyze that? And let's just remember this level, that 105.80 level. And we'll hop over here to the Analyze tab. And most of the time what I'm doing when I sell a vertical is I'm selling it somewhere around the stop level. I'm placing my short level or my short option somewhere around that stop level. So in this case, I'm looking at a 106, 101 put credit spread on the IWM in December, which is 60 something days out, I think right now, 61 days out. And what I want to do is I want to say, I know price is extended. Can I reasonably enter a trade at this point and have it make sense? And if I'm looking here, I know that 105.80, that's my level. So I'm going to move this down here to about 105.80. And I'm going to use this as sort of a point for evaluating risk. And what I like to do is I'll look here and I say, okay, if I was to sell this 106, 101 credit spread, I'd receive a credit of $75 For that, I'd be taking risk of $425. So does it make sense to enter this spread? And this is price up here right now at 110.69. This is the live price. Well, it's a close price on Friday, really is what it is. And what I see is that if price trades down to the 105.80 level, I'm going to be drawn down $90, and I'm looking down here. I'm going to be drawn down, let's just call it $90. And if I collect 80% of this spread, it's going to be 80% of $75 less commission, so it's definitely going to be less than $90, right? And what that tells me basically is that the risk, if I get stopped out on this trade, is going to be greater than the potential reward I can receive. So I'm just going to wait. I'm not going to enter a spread here. And the reason this exists is that price is just a little bit too extended. When you have these big moves up, we just have to pause and wait for price to come back down a little bit. If price was down here at 108, I'm almost positive that I'd be able to meet the risk parameters to enter a trade here at, with a stop level around 105.80. What I'm looking for, ideally, is a situation where, the immediate risk, say price trades to my stop level that day, I don't ever want that risk to be greater than the potential credit I might receive. Is sort of as a rule of thumb, what I've noticed is that if I'm trading a 2-point wide vertical, I'm usually receiving a credit of, say, anywhere between 40 and 50 cents for it. If I'm trading a 5-point wide vertical, it seems like the credit I receive is usually around $1 or $100 really. And when that's the case, the stop level generally agrees. And right now, with this IWM so extended in here, it doesn't make sense to enter a trade. It doesn't mean that I won't. If we get a pullback down here to, like, say 108.38, even 109 might give us enough leeway to get involved. But if I was going to have an order sitting in the market, what I'd probably do is I'd be expecting to sell this credit spread for somewhere around $1. So I'll just pop in $1. And what you can see here is if I had been able to sell this spread, the 106, 101 for $1, and price traded to my stop level, I'd be looking at a loss of, $66. And from a risk-reward standpoint, that makes sense. I'm expecting to lose $66 if price trades to my stop immediately, or receive a credit, 80% of that 100, which is $80. So the reward is a little bit greater than the risk. There's also a blog post out there on thetatrend.com that talks about expectancy, and it goes into detail more about what you should be looking for as far as risk-reward goes. But just sort of as a rule of thumb, it seems like the 5-point vertical, generally from a risk-reward standpoint, makes sense when you can sell it for about $1. At any rate, I hope that helps. Please visit me at www.thetatrend.com or send me an email to dan@thetatrend.com and download the system. It's out there for free. I think it's helpful. Thanks.